Hello, everyone, and welcome to today's Eagle Eye podcast. I'm Roger Michalski, publisher of Eagle Financial Publications. And today I'm here with two guests, as you can see on the screen. We got Dr. Mark Skousen, editor of Forecasts and Strategies, and we got Todd Phillips from Estate Planning Specialist. Hey guys, how you doing today?
Doing great.
Doing well. I think we both live in warm climates. I'm in Florida. And Todd, you are in Arizona. Roger, I think you're freezing up northwest, but the rest of us are
not quite
just
northwest,
fine.
But Virginia, yeah,
Northeast.
Yeah, but it's a little more chilly than what you two have. That's for sure. Starting to get the first freezes and everything. So, well, we're here. Thank you guys for joining me today on the podcast. And today we're going to talk about an investment that I think most everybody out there should have, and probably a lot of you might not have it. And, there's a lot of fears right now in the markets, and yet it seems like every day we're hitting new highs, and people are making lots of money, but there's a lot of fears. So Mark, why don't you tell us a little bit about the biggest fears out there right now and what we should do about them?
Well, I'm sure, as most of you know, I've been a pretty super bull over the last few years, despite the pandemic and all the other, bull markets climb a wall of worry, as they say on Wall Street, and that certainly has been true. And I've been 100% invested. I've been taking full advantage of this bull market. But look, the stock market's at an all-time high, which means that the higher it rises, the higher it could, or the more drastic it can fall. It just would not surprise me to see a 30% haircut in the stock market at any time. I mean, if you just look at what's been happening with Tesla, for example, going to all-time highs and then suddenly reversing and dropping sharply over a couple of days just after Elon Musk made a tweet. So it shows you how nervous investors can be. And remember, one of the things I teach all of my students at Chapman University is that stock prices are determined by a marginal number of buyers and sellers. It's not by all the shareholders. Most of the shareholders aren't buying or selling on any particular day. It's just a small number of people who buy and sell, and that determines the price of a stock. And there's a lot of factors that could reverse things. One of the reasons that the stock market is all-time high, I'm sure President Biden and the Democrats are taking credit for this, but the fact is that most of their agenda has been impeded, has been stopped. Most of their radical agenda has really not made it through Congress, and that's including the tax increases. So they got the infrastructure bill in, but that's the extent of it. So the radical agenda that they're talking about, the huge tax increases on investors, on unrealized gains and so forth, they're not happening. And so the market is happy about that. There's kind of a form of gridlock, and that gridlock will extend itself in the future, we hope. But look, there can be Middle East disruptions. China is growing in its power and influence. Inflation is coming back. Interest rates are likely to start rising again. And if we get an inverted yield curve where the short-term rates are higher than the long-term rates, that's when we get serious problems like we had in the year 2000 and in 2008. So there are a lot of factors in place here that could just tip the scales toward from a bull market to a bear market. Warren Buffett said it best. The stock market it is like a light. It can go from green to red without stopping at yellow. So you got to hedge yourself. You have to protect yourself. And there's a lot of ways to do that. And one of the purposes of this get together is to talk about an alternative investment that Todd Phillips is a specialist on. And maybe you can talk a little bit about that. And then I'll be glad to explain why I think it's a critical part of your portfolio. In fact, my wife got involved in this investment herself and did extremely well. So Todd, take it over.
All right. Thanks, Mark. Yeah. Joanne did buy some of these several years back, and then she did extremely well. And you had phenomenal timing, which I'll go to in a minute here. But Yeah, the investment we're talking about is what you called a secure retirement account. And the formal name of it is going to be an indexed annuity or an equity indexed annuity, that they also call them fixed indexed annuities. And I know a lot of times when people hear the word annuity, they think of an investment where you give the money to an insurance company and then they give you payments for the rest of your life. That's what you typically think of with an annuity. But this is different. This is more of a hedge to a portfolio. So more like a portfolio with a zero floor on the downside in a down year, and then you get some of the upside in the good year. And I'll go into some details on that in a minute. But yeah, I'm not talking about immediate annuities or even indexed annuities with income riders. You can take income, and I'll show why it's important to still be able to take income from these. But the key element is that we're not taking a loss when the market tanks. So I'll get into
let me
that.
just interrupt for a second, because I've had this debate with Mike Turner, a technical trader at the money shows on many occasions, and he makes a really important point. You know, a lot of people are not in a position to lose 50% of their stock portfolio, especially when they're near retirement. They need to protect that. They can't afford to see losing half of the value of their stocks, which happened in 2008 and 2009. And my wife avoided that with the stock index annuities. So it's a very serious worry that investors have. And I'm sure everyone who's listening right now should be concerned about that possibility.
Yeah, that's exactly why we have Todd on the program today. I mentioned before Todd jumps into more details here that he's going to have a free special report for all our Eagle subscribers and all our viewers today. So we'll tell you a little bit more about that in just a few minutes. So Todd, take it away.
Thanks. Yeah, I'm going to illustrate your point, Mark, I'm going to share my screen here real quick. Let's see. All right, can you see my screen?
Yep, it's starting to come up. There you go. Yep.
There we go.
All right. So this is just to illustrate your point, Mark, exactly like you were saying. You can't take the big hits. I've got siblings that are in their 65-year-old or in retirement or wanting to retire. And the example here is Bill and Jill. They both have $1 million. The only difference is Bill retires in 1996 and Jill retires in 1999. They both need to take 40,000 income out, and we're going to adjust with a 3% increase for inflation. Let's see, why isn't it clicking here? All right, so the difference is probably more than you think. I'm not sure if I'm blocking that. Let's see if I can turn that over there. As you can see, just because, so Bill retired in 96 and he enjoyed several years of a nice bull run. And he ends up with over $2.1 million left. So he did great. Jill, on the other hand, retired in 1999, right before the 2000 .com crash. And she only has about 1.5 million, 150,000 left. The difference is 1.9 million. And the only variable we're changing here in this example is just retiring 3 years earlier. So a pretty monumental difference for just the time that you retired and what the market conditions are like when they retired. I'm going to give another example here. Let's just look at the stock market here. Now I'm going to be showing the same example, but I'm going to be using an indexed annuity. Now, the key point with an indexed annuity is that there's a zero floor. So in the bad years, you sit safely on the sidelines and you don't lose any money. In the good years, you participate in the gain based on the performance of your underlying index. So S&P 500, Dow Jones, and now they've been coming up with several new indexes. There's over 40 different indexes that they can link to. And I have to study all of them and see which ones are the best, give you most upside potential. But this example, I wanted to keep it simple. And I just picked one that's available today that is linking to the S&P 500 with a 45% participation. So these index annuities will have some kind of modifier. And I think, Mark, you're aware of how they work, but you can they can modify your return based on the performance of the index. They could put a cap on it, maybe say the most you can make is 5%, or they could have no cap, but give you participation and say, we'll give you 40, 50% of the index or spread. And I go over this. I wrote a book on these too that you can, if you really want to learn more about the different modifiers and how they work, I'm happy to send that to your subscribers if they call in. But this example here is we're taking 45%, the index annuity is getting 45% of the upside with 0 of the downside. So if you can see here, take the 2002 crash, and I did include dividends on this. I know a lot of people say that when the people compare index annuities, they don't include dividends. I am including the S&P dividends and not including the dividends in the S&P for the index annuity. So the index annuity did not take any loss in 2000, 2002. As you can see, the 100,000 in that portfolio remained at 100,000. And then
1 million. 1 million.
I'm sorry, 1 million. And then it continued to grow, but not as high of a rate. Not even close. You could see the 2003, the S&P rebounded, got a 28% rebound. Index annuity only getting 45%, was up 12.91. And so not getting quite as much up, but you're avoiding the down. So interesting, we show at the very end, you can see the S&P today would be up to 4.7 million. So not taking any withdrawals and just letting it grow. S&P ended up winning. It was definitely behind because it didn't take it. It took losses and the index annuity didn't. But then the S&P caught up, and we've had some terrific bull years, and it is in the lead by pretty good margin, 4.7 versus 3.3 million. But it's a different story if we start taking withdrawals. So I take the same example and I said, well, let's just take 60,000 out, 6% of the portfolio out, and see how it changes. And it's pretty remarkable, actually. The S&P portfolio ran out of money by 2016. I don't know if I'm in the way with the picture there. So by 2016, ran out of money, whereas the indexed annuity still has 370,000. Why is that? Because they didn't take the big losses in the bad years in the beginning. So the key element here, it's another way, like you were saying, Roger, to diversify your portfolio and not taking these hits, which right now, if you take the S&P and just look at this graph since 2000, we've been going up on a tear. And who knows what the next part of the chart's going to look like, if it's going to continue upward like that. If it does, then great, stay in equities and stay fully in and don't worry about diversifying. But Mark, I don't know if you have anything you'd like to add to this part.
Yeah, you can look at this graph and you can see there are times when the market just crashed. And, there's an old saying on Wall Street that the market takes the stairs up and the elevator down. And you can see those elevator crashes, bear markets, they're treacherous, they happen very quickly. And we've always rebounded from it. The reason we've rebounded is because we essentially have a free enterprise capitalist system. And there's American exceptionalism. You mentioned that these insurance companies are offering all kinds of alternatives. Well, I think you should stick with US stocks because they have outperformed all the other foreign markets. All kinds of studies show that we are an exceptional economy. That's because we encourage entrepreneurship. We encourage immigration. We bring in new talent. We're a very innovative society, but we have to be careful that there's no guarantee that that will continue to be the case. So we could get into a secular bear market. I mean, there have been times when the stock market has been down for 10 years. The last time this happened was in the 1970s, actually from 1966 to 1982, the Dow Jones Industrial Average never got over 1,000. And there have been periods when individual stocks have been. I remember when Microsoft had a 10-year bear market, just didn't do anything. It's doing great now. But what's the difference? Well, they didn't really have an entrepreneur who replaced Bill Gates during that time period. Finally, they brought in an Indian entrepreneur, and he's just Nadella. He's just done a great job. So there are really no guarantees here. And we need to, all I'm saying is I'm not telling people to get out of the market or anything like that, but they do need to look at these alternative investments. And what I like particularly about the stock index annuities is that it gives you peace of mind. I mean, yes, the S&P 500 outperformed the stock index annuity over a long period of time, but just imagine the peace of mind you have when the market drops sharply. You don't get upset about it because you know that if the market ends up the year lower, you don't lose any money, and you do pay a price. You don't get to participate in the full increase in the market when it goes up, but the overall return is really pretty good. And this is a hedge. You're just protecting yourself from the unknown. And believe me, there's a lot of unknowns out there that could disrupt this bull market.
Yeah, when Todd showed me that chart of when you, because you got to take your RMDs, right? You know, at a certain age and take some money out of the market. When he showed me that chart he just had a little bit ago, where, you know, it was $0, and several years later, if you're in the annuity, you still had 370,000, if I remember the number right. I was like, I gotta have you on this podcast and you know, bring this message to our subscribers, because it's important. It's a good hedge. Everybody needs a hedge.
Thanks. Yeah, and I wanted to just put this up. This was something, you know, Mark actually came to us in 2007 and said, I want to take some chips off the table, and he did it with his own money to make sure that his portfolio was safe. So I don't know exactly what you saw in 2007, but you called it enough to tell your subscribers to take some chips off the table, like you said here, and did it with your own money.
Yeah, and we did it with an index annuity that you're recommending, and it couldn't have had better timing. Not that I knew exactly that we were headed for a 2008 crash, but you know, sometimes those of us who have been in this market a long time would kind of sense trouble ahead. That was certainly in the year 2000. I predicted a black swan event that would strike the United States and threaten this bull market. And of course, we had the pandemic and the lockdown, and that was certainly a big surprise. So there are these times when you need to take cautionary, you need to provide a hedge. You're not getting totally out of the market, but you're putting some of your money in these stock index annuities. And it's just been a very big success. And I'll tell you my wife's story at some point.
All right, thanks. I wanted to bring up this slide here of the Yale Endowment Fund. This is from 2020. I haven't seen the 2021 yet. But it's interesting. I just wanted to point out their top positions and holdings. And I mean, this isn't like an individual investor. This is a large institution with an endowment. But notice the top holding. I would say, what do you guys see as the top holding of generally across the years? The largest position.
Well, they look like stocks, right?
The absolute return.
Yeah, absolute return. And so, I mean, yeah, we had, and the next largest position is venture capital. So kind of like a barbell approach. They're one side is super safe, absolute return, absolutely won't go down. And then the next is venture capital. It's a little more on the risky side, right? Probably the most risky of all the options here. And we kind of find that with some of our clients in their portfolios is we don't want to just be all in the same thing, all in large, you know, the FANG stock, large cap stocks, and just buy and hold and have your portfolio sink or swim based on such small parts of the market. And like Yale's doing, and like we say with our clients, you need to have at least 25 to 30% in something that's super safe. So if you want to do it in CDs, or you know, you can do that, but you don't have much growth potential on bonds and CDs. And so this index annuity can substitute as that absolute return side of the portfolio, absolutely won't go down, and then get some decent upside. So I just thought I'd bring that up. Is we definitely are not encouraging 100% of a portfolio going into index annuities, but diversify part of it, 25 to 30%. It makes a lot of sense. And it, like you said, Mark, gives you that peace of mind. I'm going to give some examples if I have a few minutes, go over some that I found are pretty popular. And I'm not going to actually give the name of the product, but I will as soon as you call me or you fill out the request to get the report. For one, they're different in all the different states. There's different products available, there's different age categories, investment amounts that you're putting in. So it's not a one size fits all. There's more than 350 index annuities on the market today. I have access to all of them and I can see them and review them. So I spend a lot of time doing that. But this one here has been our most popular, I would say, this year. A+ rated company, been around over 100 years. So you've got a solid company backing. Gives you 3 unique indexes that I really like. It's got the BlackRock ESG. That's been making some headlines. Environment, social, government. Warren Buffett came out and said that's the index to beat. He sees for this next coming years. And then there's the Fidelity multi-factor. It's basically a system of using different factoring to determine how to allocate the portfolio. So that one's actually done quite well. And then this S&P Mark, which is using gold, equities, and bonds. I've been recommending this one because I'm thinking that gold should be going up more than it has been, and it hasn't been as successful as I had anticipated last year. I don't know, Mark, if you want to spend a minute going over gold, but I think that gold should be on the rise here soon. Maybe that's a long question.
Gold has been a traditional hedge for many years against inflation, but it hasn't performed that well. And I think one of the reasons is it has a new kid on the block, Bitcoin and cryptocurrencies. And I think that is a new way to hedge against inflation. Still extremely volatile, but it belongs in your portfolio. We recommend it in forecasts and strategies via the blockchain. So I do think gold has its time to shine, and hopefully, we still have it in our portfolio. So I do think it's definitely an advantage to have.
Great. I like this one in particular also because it has no cap. So the sky's the limit, and you get good participation. You get 110% participation. So sometimes you can have less than 100, you can have more. So essentially, if the index is up 10%, you're going to get 11%, unless there's a 1% fee if you choose this option to have the higher participation, and you would net 10% after the fee. So pretty good. I mean, if the index is up 10, you make 10%. That's nice. I also like it a lot because it's only a 5-year commitment. A lot of these index annuities, and you hear some gripes, is that they're really long surrender, 14, 20 year. I've seen some as high as 20-year surrender periods, or you're in it for life if you get the income riders and you need to stick with it the entire life. But we don't know what's going to happen with this market in 10 years, 20 years, but 5 years, we could kind of get a feel for. And so this is a great way to just hedge that downside for the next 5 years. After 5 years, it's completely liquid and you can move it to wherever you want. You could maybe pull out a Schwab IRA today and then put it back in the Schwab IRA after the 5 years are over. Or you can keep it if it's doing well, but there's no strings attached after 5 years, which is pretty impressive and neat. Another gripe I hear on index annuities is they can change the terms. Most contracts, they can say, okay, well, you're coming in this year at 100% participation, but they could technically change it to 60% or 70%. It's kind of a unilateral option that they can change the terms. This one in the contract, they can't change it for the full 5 years. So what you come in at is what you get. You're guaranteed for the entire course of the duration. That's a new improvement that they hadn't had until recently. So I'm excited about that feature. This next one is a 10-year, so a little longer. It has a little bit higher participation, maybe a little more upside. Last one I hit last 10 years is about a 7% return. This one maybe a little bit higher, maybe 8. It's got some unique indexes, one with 120% participation. We use this a lot for clients that we also are known for long-term care. And I know you've sent some of your subscribers to us for long-term care over the years, Mark, and sometimes they can't qualify. And this one's nice because they can get it without any kind of health qualification. It'll get them as long as if they can't perform 2 of the 6 activities of daily living, they'll get a doubling of their income. And it also gives them what's unique is a lifetime income payout that will increase if the indexes perform. It'll increase, so it's a nice inflation hedge. Continue to increase, and the terms and the upside. Most of the time, when I find these income riders, they really curtail the upside, and to give you that lifetime income, and you can get stuck. Clients can get stuck with only having the income as the option. But this one has some really good upside. So if you did want to liquidate, you got some good growth, and you've also got the opportunity to the doubling for long-term care if needed. So that's probably some two that I wanted to highlight here. But yeah, I'll stop sharing my screen here. Let's see.
All right. Well, thanks, Todd, for that. I mean, here's the thing that's so great is that, give Todd a call, and I'll have you give the number and a URL here in a second. But Todd's not going to be there, and just some people will just sell you whatever they're going to make the most commission on. Todd's going to sit down and walk through with you and give you the best for your situation, and that's what's that's why Mark and I have stood behind Todd for so many years. Is he's honest, he's going to do what's best for you, because if he does what's best for you, you're going to stay a client, and we're in it for the long term. So Todd, tell us a little bit about the special report you have and what happens if they call you or fill out the form.
Yeah, so I have a report I wrote called "If I Had $1 Million," and it's similar to what we went over in slides today, but in a little more detail. And you'll get that free report. I also have an index annuity book that I wrote. Wrote it in 2014, so I do need to update it, but I will give you access to that. And it's about a 120-page book on index annuities. You're welcome to get those if you request as well. But more importantly, I will send you like Mark Rogers said, the best ones that are available in your area for your situation. It is quite it's tough service to go through all these different contracts. They change, some of them weekly, monthly. There's always something new coming out. And I have to monitor it and study these and give the ones that I think will give the best results for you in the future. And so call in, or I'll give the number. It's
okay. Go. Yeah, please.
Yeah. It's 888-892-1102, 888-892-1102. And you can ask for me or Cindy, my colleague Cindy. She's definitely here to help as well, and she knows all the different options as well as I do. And or you can talk to my dad, David Phillips. He's also here. He's a backup. Mark and Dad go way back. But 888-892-1102, or you can go to our website, and that website is epmez.com/eagle. So it stands for Estate Planning Made Easy. So E, Edward Paul, Mary, Edward Zebra, epmez.com/eagle. And that'll take you to the request page, and you will be able to download the report "If I Had $1 Million," and also set up an appointment to talk with us.
All right. Yeah, that's great. And we'll make sure in post-production we put the number and the URL on the screen for everybody. And Mark, anything else to add to what Todd said?
Yeah, I would just like to add that we've actually tried these products. We had a really great success with a partnership that we had in Global Resource Investments with Rick Rule. We turned $25,000 into $500,000, and we came out of it in 2007. And of course, I'm more of a speculator than my wife. My wife is much more conservative. So Joanne put about $400,000 in a variety of index annuities, and it was a great move, because 2008, 2009 was a very difficult time. The stock market fell 50%. So Joanne's portfolio was even, didn't lose anything. She had peace of mind. And then she participated on the upside. Now, she didn't get full 100% participation like some of these new annuities that you have, which is great. I mean, that's very exciting. I'm very excited about this. But even then, Joanne almost doubled her money when finally she took it out in 2000 and started investing back in the stock market. And she's done well on that, but you still don't have that peace of mind and stability that you really like. But you know, that was a good run for her. And she could have done better just investing the S&P 500. They finally, after the collapse, made a big comeback. But look at the volatility and look at the security that you didn't have, worrying every day what's happening in the marketplace. So I recommend estate planning specialists, Dave Phillips and his son Todd. I've known them. I've known Dave Phillips for 50 years. We're longtime friends. And what I like about Dave and his organization, including his son Todd, they're not pushy salesmen, which you get a lot in the insurance business. You know, you basically call them, they don't call you. So it's they have a very nice attitude of answering your questions, of not pushing on a product. You decide what you want to do. They've been very successful at it. So I can recommend their services highly.
Yeah, well, thank you so much, Mark.
Thanks, Mark.
And Todd and I. Yeah, I've known them for about 20 years now, and you know that's part of what my goal at Eagle is of course we have our financial newsletters, and we have our trading services, and we have Retirement Watch. We try to cover everything for you, but we're not going to have all the products. We want to make to you available the best products, so you have the whole portfolio of everything you need. And that's why we had Todd on the podcast today. So Todd, thank you so much for spending some time and
Thanks, Roger.
Tell us about that. And Mark, thanks for joining us as well. And I want to encourage everybody to give Todd a call at 888-892-1102, or you can go online at epmez.com/Eagle. And this is a special thing Todd's put together just for Eagle subscribers. So we appreciate that, Todd. Again, thanks everybody for joining us today. Thank you, Todd and Mark, and I wish everyone a very profitable day.
Take care. Bye-bye.
Thanks.